Everybody, it's Brian. Today is Tuesday the 8th. Look carefully at this chart. This is a market that's in an uptrend. We have higher highs and we have higher lows. We never know which high is going to be the ultimate high, but when we see the markets begin to pull back, we start to say, where have we come from? Where do we have the potential to go? What are the important levels to be aware of? Right now, the important level to be aware of before we can begin to become bullish once again is that this market will need to get back above this prior little level of support from last week and the 5-day moving average, which are both together at 197. We're going to take the same approach to this pullback as we have with every other pullback, which is to say right now the market is pulling back within a primary uptrend. We want to be aware of where it has the potential to go if it fails, but more importantly, the market is innocent till proven guilty on the longer term uptrend. So we want to look at this and say it's not a reason to try to pick a top the way so many people try to do, but instead it's a reason to become cautious once again. We got cautious when it got below this 5-day moving average and went back to positive over here. We got cautious over here and we went back to positive over there. That is for swing trades and day trades that the objective was to try to find the low risk setups with upside potential. Now, we're not necessarily, as I mentioned in chat, looking for the long trades or short side trades, but instead we want to be aware of what the market presents us each day. And it's presented us with some really good opportunities, long and short today. As subscribers know, this YPF was a great long candidate, and knowing where they have come from, where they have the potential to go. So in this case with YPF, I talked about taking profits with a stop at 35.98 in chat, because we don't want to be the dopes that buy the so-called breakout after the stock has already run at this point better than 2 points. The people who buy above this previous high here, those are the people that we want to sell to as the stock comes back down, and we had our stop, as I said, right in here. So a real nice sell there. The point isn't to pat ourselves on the back, but instead to understand the approach. The approach will remain the same regardless of what the market conditions are. It's a simple process that's based on market structure and what the market tells us. Here's our primary uptrend. We could draw a trend line off of this as well and say, well, that looks important down near 185. Maybe that's where this market is headed to. We don't know where the market is going to stop. Maybe it's the 20-day moving average where we found support intraday. The point is we're not trying to buy the low. Instead, we're trying to stand aside as the market pulls back and say it just doesn't, the risks aren't worth the potential reward in here to just blindly guess while the market is declining. We need to let it set back up and prove itself to us. Here's another trend line that might be important that kind of comes together at that 195. So it seems that maybe 195 is an important level to focus on as far as potential support goes. We could also look at if we wanted to the this range for the year, and we could say Fibonacci off of this. We a 38.2% retracement would bring us all the way down to 189. But is that realistic right now? I don't think it is. Not with a rising 10, 20, and 50-day moving average. So we need to take it each chunk at a time. We're not trying to predict where the market will be at the end of the year. December 31st is completely irrelevant. What happens in the first half or the second half of the year, completely irrelevant as far as making predictions. Our job is to pull money out of the market, when it's easy and we have low risk setups. When we make mistakes, admit those mistakes quickly and move to the sidelines and wait for things to set up, rather than try to blindly guess the way so many people do as it pulls back, or to try to say that's it's the top. I'm going to short here with a stop above the high for the year, and I'm going to ride this thing out to the end of the year. If that's your style, that's fine. It hasn't been successful so far. Eventually it will, but we're going to continue to focus on where has it come from, where does it have the potential to go. So for now, we're going to be looking at maybe a pullback down towards 195. We're guilty till proven innocent in the intermediate term, as we are below a declining 5-day moving average. It's actually flat, but we're below the volume weighted, the 5-day moving average rather. We stayed below that volume weighted average price for almost the entire session, and we need to see that this market does some work and heals itself. We can't just buy it at 107.02 tomorrow if it gets above there. We want to look at it in the context of where is the support, where is the resistance. We don't want to buy it at 107.02 first thing tomorrow morning. That would be similar to the people who bought this YPF today at $36.36 because that was the new high. You don't want to be that person, or $36.26. You get the point. The point is we want to be already in it and feeding it out into the frenzy. Right now in the market, I think that for most people, cash is the correct position, and we'll take it stock by stock on a stock by stock basis. We still have a primary uptrend in the NASDAQ. Of course, we have this prior band, this little range between basically 92 and 93, and now we're in pullback mode. So we can say, since the most recent movement, the most recent move, I would say, would be right here. We can take a look at that pullback low and see that we pulled back 38.2% of it so far. A 50% retracement will get us down to 93.70. 93.50, of course, are these little peaks. So here's a potential band of support for tomorrow. This is where the market may find support. I wouldn't buy if it gets down to there, but I would be looking for signs that slowly the buyers are regaining control. We are below the 5-day moving average, and it's kind of flat, but we're going to need to see the NASDAQ get back above 95 before it can be trusted to the long side again on the intermediate term. Longer term, we're in a huge uptrend. We've expended a lot of energy getting to where we are, so it pays, I think, in this case, to be prudent and go slow in our new commitments to the long side and even to the short side. We don't want to be the dopes that sell after the decline. The Russell 2000 is in a potential area of support. We had seen this little resistance turn into support right here, and here we are once again. Same thing with this market. Where did we first get positive back on the Russell 2000? Right here at 113.50. We moved to the sidelines and got positive again here and here. Now we've done a little bit deeper damage by pulling back below the 20-day moving average, but we've got this level that seems as though it's likely to become support. So 115.5 to 116 is our key area. A lot of times, the right thing to do is to stand aside and let the market set up a little bit. So here we have another reason that this isn't important. It's 38.2% of the recent move. That is off of the May lows here. So we want to just give this market some time to settle down, and otherwise it's a day trader's opportunity, this market. You certainly don't want to sell short the Russell 2000 after a 5-point decline that came in 5 days. That's, what is that, 4.5%. You don't want to sell short after the fact. Where has it come from? It's dropped 5%. Where does it have the potential to go before it's likely to find a source of demand or support? We're right in here. We've got a retracement level. We've got this prior resistance that had become support. It doesn't mean it will become support, though. We're still guilty till proven innocent, so we want to look at it with a high level of suspicion until the market actually proves itself to us. Semiconductors were down a little bit today, and I think that $50.50 to $50.60 is going to be the key level in there. This market, of course, has had a stellar run. It's really gotten quite extended in here. A lot of people have been run over on the short side. The bigger level of potential support is down here near 49.50. That's what we've been talking about. And perhaps there's a short-term short opportunity tomorrow if it breaks back down, for day trades, maybe back below 50.15-ish with a stop above here. But that's only for the most aggressive traders. We're still in a primary uptrend. If you're going to short in here, know that you're doing so against the primary trend, and that you should be trading smaller share size or move to the sidelines if you're not comfortable with that, and that you have to absolutely adhere to your stops and keep those stops pretty close by, because odds in an uptrend favor further upside action, higher highs and higher lows. An object in motion continues in that direction until it's met with an equal or greater opposite force. And right now, we don't have ample proof that we've made an all-time high in here. We won't know that for quite a while if this ends up being a top. My suspicion is it's not. But you know what? I don't even care if it is. I don't care if it isn't. What I'm looking for is simply looking for low-risk, high-probability trades. I don't need to be right about calling the top. Let other people do that. Focus on making money. That's our job as trader, to make money. Now, we spoke about the financials and the fact that we had the possibility that we have the fact of the possibility. The possibility that we have from a failed breakout here could come a fast move lower. So we have to be on high alert that this is a breakout that is failing in here. In order for us to have confidence that it's not a failed breakout, we're going to want to see it back above 2290 to 2295, where we had this prior band of resistance, which started to hold as support, but it's now broken. So now we're looking at this market in the intermediate term as we're below the 5-day moving average. The 5-day moving average is flattening out. We've got this prior level. This looks like it should act as resistance. If it gets back up there, we're not going to short it unless it gets up and then turns back down from there. Then you can look for the short. For now, it's kind of more neutral with a real eye of suspicion on the financials. So don't be in a hurry to call tops. As you know, no one has done it correctly in the last 5 years or so. The shares of Apple, we spoke about the potential of them getting to 100 this week, and I said we don't want to focus so much on that potential of 100, but instead focus more importantly on risk management. If you got involved above this level, as we spoke about on Monday, then you wanted to raise your stop to a worst case of right around in this area. Well, that was hit today. Now we need to see that, again, where has Apple come from? It's come from 90 to 97, so it's rallied 8% or so, 7.5% in the course of a week, and it's now in need of a little bit of consolidation to tell us that it's maybe going to consolidate through time, maybe even pull back a little bit deeper price-wise. If it breaks the 5-day moving average, it shouldn't concern you. Perhaps it'll come down towards 93. But right now, we have uncertainty in the markets. Uncertainty occurs when we have conflicting messages on different time frames. Longer term, we have an uptrend. Intermediate term, we're turning sideways. Short term, the last couple days, we're turning lower. That's uncertainty. When we have uncertainty, we reduce our risk, and we do that by trading smaller share size or just sticking to cash if that's what your preference is, or taking the short-term day trades. Either way, I hope the market's treating you well. Thanks.